Breaking. Just 60 seconds ago, the US economy reportedly bled a staggering $50 billion in a single week, and shockwaves are ripping across global markets as India hits back harder than anyone anticipated. Tonight, America's losses, India's countermoves, and why this could mark the biggest shift in global trade since the last world recession. Stay with us. In an unprecedented twist, US tariff policy has backfired. As markets reeled and billions evaporated, India didn't just sit back. Instead, New Delhi rolled out a bold response package, shoring up exporters and seizing strategic economic momentum. This isn't just numbers on paper, this is real lives, real jobs, and a defining moment for India's place on the world stage. The United States government stunned global trade observers in 2025 by imposing an extraordinary 50% tariff on a large chunk of Indian exports, a move that has fundamentally reshaped one of the world's most important trade relationships. What began earlier in the year as a 25% duty was dramatically escalated by Washington when it announced an additional 25% penalty tariff, effectively doubling the cost burden on Indian goods destined for the US market. This drastic escalation came in response to India's continued purchases of Russian oil, which the US administration argued indirectly helped fund Russia's military operations, a justification that New Delhi strongly disputes and views as an unfair interference in its sovereign energy decisions. Under this sweeping tariff regime, roughly two-thirds of India's shipments to the United States, valued at around $60.2 billion annually, are now subject to the 50% duty, with labor-intensive export sectors such as textiles, apparel, gems and jewelry, leather goods, and seafood hit particularly hard. Because these industries traditionally operate on thin profit margins, the new levies have made Indian products significantly less competitive compared to those from countries like Vietnam or Bangladesh, where tariff rates remain much lower. Export orders have already been delayed or cancelled as US importers reassess the economics of sourcing from India under such punitive duties. Economists warn that if these tariffs persist, they could lead to a sharp decline in overall shipments to the US, potentially slashing exports by 40% or more and threatening hundreds of thousands of jobs in export hubs across India. This shock poses macroeconomic risks as well, with forecasts suggesting potential downward revisions in India's GDP growth and broader ripple effects on manufacturing and labor markets. The tariff action marks the deepest trade shock in decades between the two countries and has prompted New Delhi to pursue alternative markets and deepen trade ties with other partners, even as negotiations with Washington continue. When the United States slapped a dramatic 50% tariff on Indian exports in August 2025, New Delhi and businesses across India quickly began calculating the potential damage. According to the Indian government and trade bodies, roughly $48.2 billion worth of merchandise exports to the US are now subject to the steep levy, meaning more than half of what India sells to its largest trading partner could suddenly become uncompetitive or economically unviable in that market. This figure isn't just a statistic, it represents jobs, factories, and entire regional economies. Many of the hardest-hit sectors are labor-intensive industries such as textiles, garments, gems and jewelry, leather goods, and seafood. These industries traditionally operate on thin profit margins and rely on price competitiveness to win orders from US importers. With tariffs doubling from previous levels to 50%, suddenly Indian goods face a much higher cost burden compared with those from countries like Vietnam or Bangladesh, where tariff rates remain lower, and thus buyers are diverting orders away from India. Trade analysts and exporters warn that tariffs at this scale could make key shipments economically untenable, triggering production slowdowns, cancelled orders, and reduced cash flow for many small and medium enterprises. Export councils have pointed out that entire product lines may become unviable overnight, forcing companies either to absorb losses or to seek new markets. This 48-time $50 billion estimate does not account only for finished goods. It also reflects the wide range of products affected, from fabrics and garments to processed seafood and artisanal jewelry, which cumulatively represent a big chunk of India's export economy. Although some categories like pharmaceuticals and electronics were initially exempted, the bulk of India's traditional merchandise exports fall into the tariff net. Faced with this export shock, India's businesses are scrambling to reorient supply chains and explore alternative markets, even as trade negotiations with the US continue, underlining how deeply such tariffs can ripple through the economy. India's goods shipments to the United States, long one of its largest export destinations, have suffered an unprecedented drop of roughly 37.5% over just a few months, according to recent data from the Global Trade Research Initiative, GTRI. Between May and September 2025, the total value of Indian exports to the US plunged from around $8.8 billion to about $5.5 billion, marking one of the steepest and most rapid declines in recent memory in India's trade history. This collapse has coincided almost exactly with the period in which Washington sharply increased tariffs on a wide range of Indian goods, culminating in punitive duties of up to 50% on many categories by late August. The decline has been both broad and deep, affecting a spectrum of sectors from traditional labor-intensive exports to even some products that previously enjoyed lower or zero duties. Textiles, gems and jewelry, chemicals, agricultural products and machinery all recorded large contractions in export values, underscoring how vulnerable these industries are to sudden cost increases in key markets. Even categories that were previously exempt or faced lower tariffs, like some electronics and pharmaceutical shipments, saw sharp downturns as the overall trade disruption changed sourcing patterns and weakened demand. Smartphones, once a growth standout for India's exports, saw shipments collapse by more than half in the same period. The impact of this slump is not just about headline percentages. Falling shipments mean lost orders, reduced factory production, and mounting pressure on exporters who must either absorb higher costs or risk losing business entirely. It has also triggered a wider reassessment among US buyers, who are increasingly looking to alternative suppliers in Southeast Asia, the Middle East, and Africa, where tariff barriers are significantly lower. The sudden drop in exports has sent alarm bells through trade bodies and industry groups, who warn that if current trends continue, India's share in the US market could shrink significantly, putting jobs and livelihoods at risk in key manufacturing hubs. Overall, the 37.5% slump encapsulates how rapidly global trade can shift when tariff barriers are raised, and highlights the urgent need for India to diversify its export markets and strengthen trade diplomacy. When the United States escalated tariffs on Indian exports throughout 2025, the expectation among economists was that products exempt from the most punitive 50% levies, such as smartphones, certain pharmaceuticals, and other tariff-free categories, might at least hold steady. What followed surprised global trade analysts. Even these so-called protected or tariff-exempt exports fell sharply, revealing that the impact of US trade barriers goes far beyond simple duty levels. According to detailed trade data and analysis, Indian exports to the United States that technically faced zero tariffs nonetheless plunged significantly between May and September 2025, underscoring how wider market disruptions and shifting buyer behavior have compounded the problem. Smartphone shipments, long one of India's fastest-growing export categories to the US, plummeted by around 58% over this period. Shipments fell from approximately USD 2.29 billion in May to just 884.6 million by September. This dramatic contraction occurred even though many smartphones assembled in India entered the United States without the full brunt of the highest tariffs, suggesting that demand erosion, supply chain adjustments, and buyer risk aversion played a role beyond tariff costs alone. Similarly, Pharmaceuticals, another key category where US tariffs are comparatively lower or often exempt, also saw a notable decline, with export values dropping by roughly 15.7% in the same window. Given that India supplies a significant share of generic medicines to the US market, this slump pointed to broader market uncertainty and changing import patterns rather than a simple tax barrier effect. Other sectors with lower or no tariffs didn't escape unscathed either. Solar panel exports from India tumbled by more than 60%, indicating that reduced US buying interest, competitive pressure from other Asian producers, and tariff-driven pricing dynamics influence purchase decisions even where duties were not the primary cost factor. This broad-based contraction across both high-tariff and tariff-free categories highlights how the ripple effects of US trade policy have reshaped demand patterns, disrupted long-established supply chains, and pressured Indian exporters to adapt quickly to a new trading reality. When the United States slapped punitive tariffs of up to 50% on Indian exports, New Delhi moved quickly to shield its businesses and workers from the shock. India's cabinet approved a massive $450.6 billion, about $5.1 billion support package aimed at cushioning exporters from the effects of the abrupt tariff escalation and helping them stay competitive in global markets. The package has multiple components designed to address both immediate financial stress and longer-term strategic resilience. A key element is a credit guarantee program worth $200 billion, offering collateral-free bank loan support to exporters through March 2026 so they can maintain liquidity, finance operations, and continue fulfilling orders even as costs rise. The guarantees cover loans up to $500 million per exporter, a move intended to relieve pressure on small and medium enterprises that traditionally struggle to secure affordable finance. In addition, $250.6 billion has been allocated over 6 years to bolster trade finance, logistics, and export promotion efforts that help Indian goods reach new and existing markets more effectively. This part of the plan aims to improve competitiveness by expanding access to affordable trade finance, enhancing logistics infrastructure, encouraging participation in international trade shows, and supporting exporters in diversifying into new geographies beyond the United States. Officials have stressed that labor-intensive sectors like textiles, jewelry, leather goods, seafood, and chemicals, which have been hit hardest by US tariffs, are among the primary beneficiaries of these measures, with the support package also intended to protect jobs in critical industrial hubs. This relief effort follows industry warnings that more than half of India's exports to the US had become less competitive due to higher tariff costs compared with rival suppliers in Southeast Asia and other regions. By providing credit support and strengthening trade promotion, New Delhi hopes to blunt the negative impact of US trade barriers, keep export orders flowing, and give Indian producers time to pivot or expand into alternative markets. The package underscores the government's commitment to protecting domestic exporters and sustaining export-driven growth, even as negotiations with the United States continue and talks toward a broader trade agreement remain underway. When analyzing the broader economic context behind the US losing up to $50 billion in a single week, it's crucial to understand that the American economy was already under significant strain before trade tensions with India hit their peak. One of the most profound pressures has been the 2025 US federal government shutdown, a political standoff that dragged on for weeks and resulted in deep economic disruption across multiple sectors. According to the Nonpartisan Congressional Budget Office, CBO, the shutdown has already inflicted billions of dollars in permanent economic damage by halting federal operations, delaying government spending, and disrupting private sector activity. Over the course of the closure, output that would normally have occurred simply vanished, meaning real goods and services that should have been produced never materialized, a direct hit to GDP growth. Estimates vary, depending on how long the shutdown continues, But the CBO projected permanent losses between about $7 billion and $14 billion in GDP output, even after the economy rebounds when the government eventually reopens. In fact, some reports suggest that the cumulative economic toll of the shutdown has already reached at least $18 billion in lost activity as federal employees were furloughed and consumer confidence weakened. Beyond the headline figures, the shutdown's ripple effects were felt in everyday commerce. Federal workers missing paychecks meant reduced household spending, travel and tourism sectors lost revenue as national parks and transportation services stalled, and private companies awaiting government permits or contracts faced delays that slowed investment and hiring. Economists point out that even when a shutdown ends and back pay is issued, the output lost during the shutdown period cannot be recovered because goods and services simply weren't produced in the first place. This creates a persistent drag on growth, consumer confidence, and market stability. When combined with other headwinds, including policy uncertainty and inflationary pressures tied to tariffs, these factors help explain why the U.S. economy has been vulnerable to shocks, amplifying the impact of international trade disputes such as the one with India. India's economy has shown surprising strength and resilience, even as U.S. tariffs bite into exports and global headwinds build. Despite trade tensions, multiple independent forecasts still project solid growth for the Indian economy in FY 2025-26 and beyond, a sign that the country isn't collapsing under external pressure, but instead is riding on strong internal engines. According to major ratings agencies like S&P Global, India is expected to grow around 6.5% in FY 2025-26, underpinned by robust domestic consumption, manageable inflation, and service sector dynamism that help counteract the drag from external trade shocks. Even multilateral institutions agree that India's economy remains comparatively resilient. The Asian Development Bank, ADB, revised its growth outlook to about 6.5%, noting that while U.S. tariffs will weigh on exports, the fallout could be cushioned by increased internal demand, strong services exports, and lower exposure of the export sector to overall GDP than many realize. Beyond forecasts, real data shows that parts of India's economy have performed quite well amid the tariff storm. Recent quarterly GDP estimates indicate sharp expansions in key domestic sectors, with growth surging into the 8% range in some quarters even as global challenges mounted. The continuing strength has several roots. India's massive internal market, powered by rising middle-class consumption, accounts for a much larger share of GDP than exports to any one country, meaning the economy isn't overly dependent on U.S. trade alone. Exports to the United States make up only a modest share of India's total output, so while they matter a lot politically and for specific sectors, their impact on overall economic growth is less dramatic. India's services sector, from IT and pharmaceuticals to business services, continues to perform strongly, often unaffected by tariffs that primarily target manufactured goods. Growth in these segments helps offset stress in goods exports and contributes significantly to overall GDP. Taken together, these trends suggest that although external threats like punitive tariffs create real pain points for certain exporters, India's broader economic engine remains intact and continues to drive respectable growth, making it one of the faster-growing major economies even amid global trade turmoil and recessionary pressures elsewhere. In 2025, relations between India and the United States entered one of their most challenging periods in years, as a sharp escalation in trade disputes beginning in August triggered a broader diplomatic crisis. What started as tariff disagreements quickly spread into other areas of bilateral engagement, fundamentally straining ties that had been on a trajectory of deepening strategic partnership for decades. The crisis was driven in large part by the U.S. imposition of sweeping tariffs on Indian exports, first with a 25% reciprocal duty and then an additional 25% penalty linked to India's continued purchase of Russian oil, bringing the total tariff burden on many Indian goods to a staggering 50%, among the highest rates the United States has ever applied to any trading partner. India strongly condemned these measures as unfair and unjustified, asserting that its energy choices reflect sovereign policy and strategic autonomy rather than any intent to harm U.S. interests. The tensions have spilled over beyond trade into diplomatic signaling. Reports in Reuters and other outlets highlight concerns that the tariff conflict threatened to undo years of diplomatic progress, with both sides re-evaluating areas of cooperation. Trade negotiations that once aimed for a comprehensive bilateral agreement, including plans to double trade to $500 billion by 2030, stalled as the crisis deepened. A sixth round of trade talks scheduled for late August was postponed amid rising friction, dampening hopes of a quick resolution to the dispute. India's External Affairs Minister publicly described the tariffs as unfair at an economic conclave, underscoring that negotiations had yet to find common ground and signaling New Delhi's firm stance even as both sides continued dialogue. Despite the tensions, efforts at diplomatic engagement have not ceased. High-level meetings and talks continue as both countries seek to manage the fallout while preserving broader strategic and security cooperation, reflecting the complex and multifaceted nature of US-India ties in 2025.